Top 10 Financial Mistakes to Avoid in Your 20s and 30s. Your 20s and 30s are the foundation years of your financial life. Many people unknowingly fall into financial traps, delaying their goals and creating stress. The decisions you make during this time can shape your wealth, stability, and freedom for decades to come. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. 1. Ignoring budgeting and spending habits. One of the biggest mistakes people make in their 20s and 30s is failing to track their income and expenses. Without a budget, it's easy to overspend on lifestyle upgrades like dining out, shopping, or vacations while neglecting savings. This results in living paycheck to paycheck, even with a good salary. Tools like budgeting apps or simple spreadsheets can help. Budgeting is not about restricting joy, it's about knowing where your money goes and making intentional choices. Creating categories for essentials, savings, and discretionary spending ensures balance. If you don't start building this habit early, you may face constant financial pressure and miss opportunities for investment. The earlier you learn to control your spending, the more control you'll have over your future wealth. 2. Relying too much on credit cards and debt. Credit cards are convenient, but misusing them can lead to crushing debt. Many young adults fall into the trap of buying luxuries on credit, forgetting that high interest rates compound quickly. Missing payments lowers your credit score, making it harder to get favorable loans in the future. Instead of treating credit cards as extra income, they should be used responsibly, ideally paying the full balance each month. Building a strong credit history is essential, but carrying revolving debt creates financial stress. Learning to distinguish between good debt, like an education loan or mortgage, and bad debt, impulse purchases, is crucial. The sooner you manage credit wisely, the easier it will be to achieve milestones like buying a house or starting a business. 3. Not saving or investing early. Delaying saving and investing is perhaps the most damaging financial mistake in your 20s and 30s. Many people think they'll start later when they earn more, but time is the most powerful tool in wealth building. Thanks to compound interest, even small amounts invested early can grow significantly. Waiting until your 30s or 40s means you miss out on years of growth. Instead of keeping all your money in a low-interest savings account, explore retirement accounts, index funds, or diversified portfolios. Automating savings is an excellent way to ensure consistency. By prioritizing investments early, you'll create financial security and more freedom later in life. 4. Neglecting an emergency fund. Life is unpredictable. Medical expenses, job loss, or sudden repairs can happen anytime. Without an emergency fund, you'll be forced to rely on credit cards or loans, creating unnecessary debt. Many young adults don't prioritize building a safety net, assuming emergencies won't happen soon. Ideally, you should save at least 3 to 6 months' worth of living expenses in an easily accessible account. This fund acts as a financial cushion, reducing stress when unexpected events occur. Even small, consistent. By having this safety net, you'll avoid financial panic and keep your long-term goals on track. Contributions can build a strong emergency reserve over time. 5. Lifestyle inflation and overspending. As income increases, many young professionals immediately raise their lifestyle, buying luxury items, upgrading apartments, or dining out frequently. While rewarding yourself is important, unchecked lifestyle inflation can sabotage long-term financial goals. Instead of using pay raises to enhance savings or investments, the money disappears into higher living expenses. This creates a cycle where even with a good salary, financial progress feels stagnant. The key is balance. Allocate a portion of your raises toward enjoying life, but direct the rest toward savings, debt repayment, or investments. 6. Avoiding retirement planning. Retirement feels distant in your 20s and 30s, but the earlier you start, the easier it becomes. Many young people delay contributing to retirement accounts like 401ks, IRAs, or pension schemes, assuming they have decades to catch up. However, procrastination means missing out on employer matching benefits, tax advantages, and compound growth. Even modest contributions now can grow into significant wealth later. Contributions and more sacrifices. Ignoring retirement planning often results in scrambling to save in your 40s and 50s, which requires larger. 7. Not learning about personal finance. Another mistake is neglecting financial education. Relying on guesswork or misinformation often leads to costly errors. Many people enter adulthood without understanding how credit works, how to invest, or how taxes affect income. Financial literacy is not taught extensively in schools, so self-education becomes vital. Reading books, listening to podcasts, or following credible financial experts online can drastically improve decision-making. Without knowledge, you may fall prey to scams, poor investments, or high-interest debt traps. 8. Neglecting health and insurance. Health issues can derail financial stability if you're not prepared. Many young adults think they're too healthy to need insurance, but accidents or sudden illnesses can bring huge expenses. Without health or life insurance, even minor emergencies can turn into financial disasters. Employer coverage may not always be sufficient, so it's important to evaluate your needs and consider additional coverage. Investing in your health through regular exercise, healthy eating, and preventive care is equally important. Medical debt is one of the leading causes of financial. 9. Comparing yourself to others. A subtle yet destructive financial mistake is comparing your lifestyle to peers. This comparison trap creates unnecessary debt and dissatisfaction. Social media often exaggerates wealth, leading to pressure to match others' spending habits on gadgets, vacations, or luxury items. Everyone's financial journey is different, and appearances can be misleading. Many people flaunting wealth may actually be drowning in debt. Instead of competing, focus on your own financial goals and progress. Tracking your net worth, savings, and investments provides a more meaningful measure than comparing with others. 10. Ignoring multiple income streams. Relying solely on one job for income is risky, especially in an unstable economy. Many young adults focus only on their salaries without exploring side hustles, freelancing, or passive income opportunities. If you lose your job or face unexpected expenses, the lack of backup income can create serious problems. Building multiple income streams, even small ones, provides security and accelerates wealth building. This could include freelance work, online businesses, investments, or rental income. With technology today, side hustles are more accessible than ever. Ignoring this potential is a missed opportunity to strengthen your financial foundation. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest video. Share your thoughts in the comments below. Thank you for watching.